Okay, let's just imagine for a second. It's January 1st, 2026. You're starting with basically zero in assets, maybe you've got some debt, and your job is, well, it pays the bills. All you see in the headlines is screaming about the economy and interest rates, and for most people, this is where they just freeze. They think the game is rigged. But what if I told you there's a mathematical path to wealth, a real one, built for the world we're actually living in? It all starts with one kind of shocking number.
So before we even get into the strategy, we have to talk about this. 92%. You know what that is? Over a 15-year stretch, more than 92% of the pros, the highly paid fund managers with teams of analysts, they failed to beat the simple S&P 500 index. That's just the 500 biggest companies in the US. These are the experts.
And that really makes you wonder, right? If the people who do this for a living can't win, what chance do you or I have? It's so easy to feel hopeless, especially when you're fighting these invisible forces like credit card debt or just our own emotions making us buy high and sell low. The system can feel designed to make you fail, but actually their failure, that's our biggest advantage.
And here's the wild part. There is a reliable way to get wealthy. And it has absolutely nothing to do with being some stock-picking genius or trying to time the market. No, it's about following a simple mathematical path that puts the odds right back in your favor, no matter what the news is yelling about.
And this is that path, a 5-step playbook to take you from zero to financially solid. We're going to destroy your debt, build a cash fortress, automate your investment engine, put up a tax shield, and finally upgrade your income shovel. This is the whole game plan.
First things first, if you're starting from zero, but you've got high-interest debt, like from a credit card, your net worth isn't really zero, it's negative. Seriously. This debt is like an invisible anchor dragging you down, a trap where compounding is working against you. So before we even think about buying a single stock, we have to cut that anchor loose.
And the math on this is just brutally simple, but it's on our side. Look, paying off a credit card that's charging you 24% interest is the same as getting a guaranteed 24% return on your money. Tell me, where else can you find a guaranteed, risk-free 24% return? You can't. Trying to invest your way out of that kind of debt is like trying to fill a bucket with a giant hole in the bottom.
But beyond the numbers, this is the hidden benefit. Getting rid of that debt is a huge psychological win. It unlocks something. When you're not chained to a bank, you're not so scared to take a smart risk at your job or ask for that big raise or move for a better opportunity. It flips you from a defensive, scarcity mindset to an offensive one, where you can finally start playing to win.
All right, so once that high-interest debt is history, the temptation is to just throw every spare dollar into the market. Don't do it. That's a trap. First, we need to build a cash fortress. I'm talking about an emergency fund with 3 to 6 months of living expenses. At this stage, you have to remember, cash isn't an investment, it's your insurance policy.
And let me show you why this is absolutely non-negotiable. So imagine the market tanks by 20%. And just my luck, you lose your job. Investor A, with no cash, is forced to sell their stocks at the worst possible time just to pay the bills. They lock in that 20% loss forever. But Investor B? They tap into their cash fortress, leave their investments completely untouched to recover later, and they come out just fine. The winner is always the person who never has to sell at the wrong time.
You know, the real power here is what it does to your brain. This cash buffer creates a space between a stressful event, the stimulus, and your financial decision, the response. It lets you look at a scary market crash and not see a catastrophe, but maybe, just maybe, a buying opportunity. It protects you from your own worst enemy, which is usually yourself.
Okay, so the debt is gone. The cash fortress is built. Now, finally, we invest. But here's the secret. We're going to make it as boring as possible. Why? Because the problem with investing isn't that it's complicated. It's that the right way to do it is mind-numbingly boring. We want action and excitement. But for building real wealth, reliability crushes lottery tickets every single time. Just remember, being average in the stock market over the long run actually makes you rich.
So how do we stick to a boring plan when our brains are wired for excitement? Well, we basically hack our own psychology. It's something called the core satellite approach. It's a clever strategy that lets you scratch that itch to take action, to get in the game without risking your entire financial future.
Here's how it works. It's super simple. 90% of your investment money, that's the core, it goes into automated, low-cost index funds that just track the whole market. This is the boring part that quietly does the heavy lifting and builds your wealth. The other 10%, that's the satellite, that's your fun money.
If you want to bet on a hot tech stock or some crypto, you do it with this money. If it goes to zero, who cares? Your main financial plan is completely safe. It satisfies the urge to gamble without blowing up the whole system.
Now, you could do all of this perfectly up to this point and still lose like 30% of your wealth to this silent killer, taxes. Most people get obsessed with what stocks to buy, but they totally ignore where they're buying them, in what type of account. You got to remember, it's not about what you make, it's about what you actually get to keep. Let me give you a really powerful example. Let's say you have an investment that grows by $90,000 over 30 years. If that's in a normal taxable brokerage account, when you go to sell it, you could owe $18,000, maybe even more in taxes. Poof, gone. But if that same investment was inside a Roth IRA, which is just a special retirement account, that money grows and can be taken out completely, 100% tax-free. You keep the entire 90 grand. That's not being a better investor, it's just picking the right account.
So the game plan here is a waterfall. You fill up these accounts in a very specific order to build the biggest tax shield possible. First, you put money in your 401k, but only up to what your employer matches. That's free money. You have to take it. Then, you max out a Roth IRA. After that, if you can, a health savings account, or HSA. Only after all those special accounts are full do you even think about putting $1 into a regular taxable account.
And this brings us to the final step, and honestly, it's the biggest accelerator of them all. Everything we've talked about so far, saving, investing, that's all defense. And defense is great, it keeps you from losing, but offense is how you win the game. There is a very real limit to how much you can cut from your budget, but there is no limit on how much you can earn. You simply cannot budget your way to being wealthy.
This means you have to make a huge mental shift. Stop pouring all your energy into how to save $5 clipping coupons and start focusing that energy on how to earn an extra $5,000 by developing valuable skills. A $10,000 or $20,000 raise at your job is infinitely more powerful than any budget hack you can find.
But look, this is the hard part. It means you have to learn new things. You have to be a beginner again. It means you have to get uncomfortable. Because as the saying goes, the comfort zone is where your financial dreams go to die. If you really want to accelerate your wealth, you've got to be willing to step outside of it. So that brings us to the final question, the one I want to leave you with. Take a hard look at your job, your career, what you're good at, and ask yourself this. What is the one skill that, if you truly, completely mastered it, would make you absolutely undeniable in your field? Find that skill, because that is the accelerator for this entire plan.